Hi class, in this video clip we're going to talk about start chapter 11, which is the stockholders equity section of the balance sheet. And in this video clip we're going to talk about what is the role of stock in financing a corporation. Basically, only corporation can issue stock, and the other thing is how to record stock issuance. Okay, so only cover learning objective 1 and learning objective 2 in chapter 11. All right, now let's get started. Okay, so chapter 11. So before we talk about the stock, and we want to talk about which type of company can specifically own stock, or basically everyone can own stock, but which company is able to issue stock. Okay, which type of company is able to issue stock, and that is ownership, corporation. Okay, before we get into this, in chapter 1 we talk about 3 different type of business: sole proprietorship, partnership, and corporation, right? And only corporations can issue stock. Okay, so and what is corporation? And you know this, right? Corporation is a separate legal entity, not only a separate business entity, but also a separate legal entity, which means the company itself is a artificial individual. Okay, the company itself is an artificial individual, and the company itself is responsible for its own activities, behaviors. It can own assets. It can own liabilities. All right, and they can sign contract with their partners, with their employees, with their suppliers and customers, and so on and so forth. Okay, so also if you run into a lawsuit, and the company itself is can be sued, or can sue other entity. Okay, all right. So there are some advantages for a corporate form of business, and first of all is it's simple to become an owner. Okay, so how do we become an owner of a corporate? Okay, all those companies that you see on the stock market, those companies are corporations. Okay, and when you decided to become the owner of one of those companies, just simply open up a stock account or investment account and buy several shares of that company's common stock. You will become the owner of that company. Okay, so that is very easy to become the owner of the corporation. And if you are thinking that, okay, I'm not gonna own this company shares for any longer in the future, so you can decide to sell out your stock, and then someone else on the market will buy it. Okay, someone else on the market will buy it, and then it's a very easy method to transfer the ownership of the company. Okay, transfer the ownership of the company. Okay. And also it provides limited liabilities. Okay, remember when we talk about that landscaping business, and you are the owner and you run into somebody while you're doing your business and got that people killed. Okay, so if you're a corporation, you are not going to be sued after your personal assets. Remember? Okay, so it only has limited liabilities to the owners. Okay, you will not to lose everything that you have for some accidents that happens. Okay. All right. So for a stockholders, basically that is the owner of the company. And you have several benefits. First is the voting rights. So voting rights basically means that if you are the company's owners, you have their shares of stocks, then you have to decide by voting that who is going to be the member of board of directors, and who is going to be the member of internal auditing committees, and so on and so forth. Okay, and those top management teams, basically you have the rights to vote to decide which one can sit in office. Okay, and second is you're gonna be paid dividends. Okay, remember dividends is the withdrawal of the owner by the owner from the company, right? You invested in the business, and you hopefully that you can get some premiums out of it, right? So once the companies earn profits, how do you get your bonus or the extra money out of the company? Through dividends, right? Dividends. And dividends is not by law, it is not required It is not required. It is just voluntarily to declare dividends. Okay, if companies decided they're gonna issue dividends to the owners, then you will get something back. Okay, if companies said I'm not gonna give any dividends to the owners, and you don't have any dividends going to be received for the year. Okay, so for example, Amazon never gave dividends to their owners. Okay, they only appreciate the stock price premium. Okay, that's it. Okay, you don't earn dividends. But AT&T, that is a company on a stock market as well, but dividends for AT&T is annually, that is $2.04, $2.04 per share. Okay, if you own one share of AT&T common stock, you will earn $2.04 from the dividends each year. Okay, so it depends on the company policy. Okay, and it can change year after year. And residual claims, you don't really see this very often, and the only time you will see residual claims for the owners is once the company is going to bankruptcy, or there's a lawsuit that companies will close up, and after they pay off all those liabilities, those debts, and paid off those lawsuit loss, and whatever is left, whatever left over in the company, and as an owner you have rights to claim those residual assets or resource. Okay, but there is a order. Okay, so you have to pay off those liability claimers, and then you have to, and then it's you to claim the residual resources. And the last one is preemptive rights. So what is preemptive rights? Basically, that is if you are the owners and companies decide to issue more shares of common stock on the market, and they will gonna come to you and to ask you if you are willing to buy more shares from the company before they issue the additional shares on the market. So you have the rights to purchase your company's shares in advance before anyone else on the market could buy that. Okay, that makes sense. So those are the four benefits that owners have, the stockholders have. Okay. All right, so equity versus debt financing. So which one is better? Which one is worse? Okay, so it depends. Okay, there's nothing to say that one is always be better than the other one. Okay, so it depends on the company's status and their financial status as well. Okay, so there are some advantage of debt. Equity does not have to be repaid. It's just not like debts that you have to pay interest. Not only interest, but also you have to pay back the principals at a certain at a later date, right? So those are the money that you owe to the loaners and to the lenders and to those financial institutions. Okay, you're gonna pay those things back. But for equity, basically stocks that you don't have to pay it back. I'm saying from the corporation's perspective, not from the investor's perspective. Okay, so companies issue stock, and the owners will contribute in their cash, and then as a return, the company is giving you the shares of the company, right? So there's no way you can claim the liabilities. Okay, so and also the dividends are optional. That means that dividends are not always guaranteed. It depends on the company's position and their conditions, based off on the market or based off on the economic status as in general. Okay. And advantage of debt, first is interest on debt is tax deductible. That means if you are loaning some money from financial institutes and you pay those debt interest, and interests will be tax deductible. Okay, so remember this before we pay tax, and when we calculate our income using the net income statement, we always have income from operations, and then it's interest expense, and after we deduct interest expense from the income from operations, then we calculate the tax, right? So that means interest expense always going to be deducted before we calculate our income tax. Okay, so if you are borrowing that, it's gonna cut your taxes for a certain percentage. And second is that does not change stockholders' control. That means if you are borrowing money through debt, if you are borrowing money from those financial institutions, you don't really dilute the ownership percentage. Okay, so if you're issuing more shares, and then before probably you own 1 share or 2 shares of the company, and if you're issuing more share, and your percentage of ownership probably going to decrease to 1% or 0.5%. But if you are borrowing money from financial institutions, then your ownership percentage doesn't change. Okay, you own 10% of your company, and then by using that, then your ownership of the company will not be shrinked. Okay, so to speak. So that depends. Okay, so there are 4 parts in the stockholders' equity section. In terms of balance sheet, there are 4 sections. First is contributed capital. Okay, contributed capital, and that is, before the company started, and we have to have those resources to start up the company: buildings, equipment, human resources, knowledge, and patents, all these things, right? And we have all these things together in cash, and then we're going to convert that into certain number of shares of company's ownership, and then distribute it to the owners, whoever contributed in the companies, right? So those are the contributed capital. And after that, we have something called retained earnings. Okay, so what is retained earnings? Those are the earnings, net income that earned from year to year and not distributed to the owners, which means retained earnings are the profits we get to contained in the company itself, okay, and accumulated from year to year, and it's called retained earnings. And the other one is another one is called a treasury stock. Okay, treasury stock. Treasury stock also is a stock, but it's a different term of stock, and it's used for different purpose. Okay, so we're going to talk about this later in this chapter. And then we have something called accumulated other comprehensive income and loss, and this item is not through the regular business. Okay, so it's not from your operating activities. It's from other things. And in this chapter, also in this course, we don't talk a lot about this thing, because it's very complicated thing to talk about. Okay, so for us, we don't need to worry about this too much. Okay, so we only focus on these 3 things. All right. Okay, so now let's talk about the common stock transactions and how do we record those things in the accounting system. Okay, so here is the partial balance sheet, and focus on the stockholders equity section. And when we prepare a balance sheet, and as of now that we have a lot of detailed items need to fill in the balance sheet, and for stockholders equity, this section specifically, we're gonna follow this order. Okay, so first is contributed capital, and in this section we have different type of stock: preferred stock, common stock, and additional paid-in capital. And after this contributed capital section, we have this retained earnings section, and after that is treasury stock, and followed by accumulated other comprehensive income. Okay, and then we'll do a total stockholders equity. Okay, so again, if you have a positive number, which you have a credit balance for all of these accounts, these numbers are going to be positive. And if you are carrying a debit balance for any one of these accounts, you're gonna put in parentheses. Okay. All right. So stock authorization. Okay, stock authorization, and here we're gonna talk about some two different values for a stock. Okay, so first is par value, and par value is typically a very nominal amount, such as 1 cent per share, and it's arbitrary. Okay, it's not defined by the stock market, it's defined by the company and by some regulations. Okay, so this is the arbitrary number and doesn't have anything to do with the stock price on the market. Okay, it is not a price you pay to buy or to own 1 share of the company's stock. Okay, it is different stock price. Okay, and it is different from market price, and market price is how much we pay for buying one share of the stock on the market, right? And that market price is defined by the supply and demand, and then other companies' performance or economic situation. And for example, several weeks ago, when the president announced some bad news, and the financial market is starting to clapping, right? And its stock price it's dropping, okay? And so it's different, okay? This is how much we pay to get one share of the stock from the stock market. The par value is an arbitrary amount and assigned to each share of stock when it's authorized, okay? When it's authorized. And this only for accounting purpose for us in this chapter and in this course, for us to record journal entries when we issue stock, okay? When we issue stock. All right. So no par value common stock. Also, there are some common stocks that don't carry any par value, and that's okay, okay. But you don't see a lot of companies who doesn't have a common stock that with no par value. All right. Okay. Stock issurance. Okay. Stock issurance. For example, this company, National Beverage, and issue stock. So first, this issue stock is through IPO, initial public offering. Okay, initial public offering, and that is the first time. That is the first time that a corporation issues stock to the public. Okay, the only first time that issued to the public, the corporation issued to the public, is called initial public offering, and it's called IPO. Okay, IPO. And after that, anyone who purchased the stock is from the secondary market, okay? From the secondary market. It is not initial public offering, okay? So when is initial public offering? When the companies decide to go public, and then they will do roadshow and to illustrate how strong the company's performance is and their financials is, and then to attract the public interest to buy their shares, right? And then they will announce a day to issue that stock, and then people who have interested, and then they can apply to purchase those stock, because 99% of the time we have so many people on the financial market, and to seek for opportunities to earn money, okay, there are always gonna be more buyers. Another way of saying this, we're gonna always have more demand than supplies for initial public offering. Okay, so then you can ask somebody who is familiar with the investment market and who is actually doing stock investments. And whenever a company is issuing those new stocks, they have to put in an application through their stock account, investment account. And then because we have so many people who are interested in buying a so limited amount of stock, and then the company or whoever the authorized financial or investment agency that will pull all these applications together and draw lucky numbers from lottery. Okay, so they will actually draw those people's from the applicant pools, and whoever got drawn from the application pool will have the rights to buy their initial offering, okay, the initial shares, and that process is considered IPO. And after that thing happens, everything you purchase on the market is from secondary, okay, secondary market. All right. Alright, so most issues of stock to the public are cash transactions. Okay, so think about when you open your investment account and you want to buy stock. Really, either you can swipe your credit card, or literally you have to use your bank card, okay, which means you have to literally have certain amount of cash sitting in your bank account and transfer it to your investment account, and then use the money to buy. There will not be something that you can really buy on credit. That makes sense? Okay, so always going to be a cash transaction, okay? Always going to be a cash transaction for simplicity for now, okay? So National Beverage issue 100,000 shares of 1 cent par value common stock for $20 per share. So because we have two different values here, one is how much we're gonna pay for getting 1 share of the stock, and how much it is worth, arbitrarily how much it is worth to the company itself. Okay, so for the company, from the company's perspective, and as the accountant for the company, how do we record these transactions in accounting journal entries, and to record this stock issuance, right? So we issued 100,000 shares, and the investors on the market will have to pay $20 per share to own these 100,000 shares. So in total, how much cash we obtained from issuing this 100,000 shares? That is 100,000 shares times $20 per share. Okay, $20 per share times 100,000 shares. Okay. So in total, we will receive $2 million. Okay, $2 million. And then how do we record this $2 million? So from the following journal entry. Okay, from the following journal entry. Okay, so we're gonna debit, because we're receiving $2 million. Okay, so we're gonna debit cash for $2 million. And now here is the important part when we record a stock issuance. Okay, we're gonna do two different things here on the debit side, on the credit side, excuse me. First is common stock, which we only record the number of shares we issued along with this par value. Okay, each one of these 100,000 shares is worth 1 cent, the par value, and common stock, this specific account only record the par value of those stock number of shares we issued for the par value. Okay, so when one share is worth 1 cent and we issued 100,000 shares, in total is $1,000, and that is that balance, right? So we use some other things called additional paid-in capital. What is additional paid capital? That is additional to the par value, how much more the investors has paid us. Okay, has paid us, and that is why it's called additional paid in. Okay, additional paid in. That is additional to the par value. Okay, how much we received, and we received a total that's $2 million, and additional to the par value, we received $1,999,000. Okay, so then make that balance. Okay, this is always how we record this stock issuance. We're always gonna have debit in cash and credit common stock for its par value of those number of shares we issued, and then additional paid in to record those amount that beyond the par value. That makes sense? So common stock used to compensate employees. Okay, if you are going to be working for some tech companies in the future, for example Amazon, okay, when you sign off on the Amazon's employment contract, you're gonna get some stock options. Okay, you're gonna get some stock options. What stock options is, we're gonna talk about that just in a few minutes. Okay, so you will have some stock options. Basically, that means in the future you're gonna own shares of companies. You own several shares of the Amazon company. Okay, so why companies will give common stock to their employees, and there are something is they will use this for motivation. Okay, so there's for motivation. They're used for motivation. If you are working harder, and theoretically speaking, that means everyone is inside of the company is working harder toward the goal of the company, and company profitability will increase over year, right? And the stock price on the market, theoretically, that based off on the company's financial performance. Okay, so if earning more profits and attract more potential buyers on the market, and because the limited amount of supplies, demand increase, this price will be higher. Okay, the price will be higher. So one thing that will contribute to the company by working harder, and the company's profitability will improve over the years. And the second, the employees will appreciate by those price appreciation. Okay, they can sell it at a later date. Okay. All right. Then what is stock options? Stock options basically is the option to give the employees that an option to acquire company stock at a later date and at a predetermined price. So that means, for example, if the stock price currently is $100 per share, okay, on the market. If you're not employee of the company and you're just simply a investors on the market, if you want to buy a share of the company's stock, you have to pay $100 for a share, okay. But since you are the employees of the company and you sign off this, you receive this common stock options from the company that says in the future date, if your performance meet a certain standards, you have the rights to purchase the company stock, certain number of company stock at a predetermined price. And this predetermined price, not always, but most of the time, is way below the fair market value, okay? The fair market value or the market price, okay? For example, it could be $50 per share or $30 per share or $80 per share. But most of the time, it's going to be the predetermined price will be lower than the market price, okay? There's something bad happens, okay? Company's performance is in the downsides, okay? Then the price could be higher than that, okay? Could be higher than that, okay? So it happens, okay? All right, so stock exchange between investors. And if you are the owners of the company and then next day you said, okay, I want to switch from Apple to AT&T, and you need to sell your Apple's stock, right? You don't just sell it back to the company, you sell it on the market, and someone on the market who is interested in getting Apple shares will buy from you, even though you don't feel it that way, but it's just how it works, okay? So because we have so many buyers and so many sellers on the market at the same time, okay, so there are the total number of shares that these sellers are going to sell, and then we'll put in the request, selling request, okay, sales request, and here those buyers will put in the purchase request, and then when the price matches with each other, the sales price they offer and with those purchase price that they're willing to pay, if they're matched together for a certain number of shares, and then the transaction will take place, okay? Otherwise will not, okay? So that is how we transfer ownership from owners to owners, okay, on the investment market. However, this process doesn't have nothing to do with the company per se, right? So as the accountant for the company, this is something happened outside of the company, and it's not any transactions that we do with that they do with the company itself. So since the company itself is not involved in this, stock transfer transaction, we don't need to record this journal entry because it's nothing done with us, okay? It is not something done with us, all right? And treasury stock. What is treasury stock, right? So treasury stock is repurchase of stock. Who repurchase stock? The repurchase stock by the company itself, okay? So if there are 1 million shares, 1 million common shares, 1 million shares of common stock circulated on the market, okay? 1 million shares circulated on the market, okay? And the company said, okay, for some reasons, I have enough cash to buy something. I don't know where I should invest my money in, so I just decided to buy some shares from the company itself, buy some shares from the market, okay, investment market, and then the company buy 500,000 shares, and this 500,000, let's say 400,000 shares, okay, 400,000 shares, just those 400,000 shares are treasury stock, Those 4,000 shares, 400,000 shares are purchased back by the company, and is repurchased, and then it's called the treasury stock, and this will be recorded under the company's balance sheet under that stockholders equity section, okay? And so if we have 1 million shares circulated on the market, which is called outstanding, okay? Outstanding. Before this purchase, we have 1 million shares circulated on the market, and this is called outstanding shares. Okay, outstanding shares. And then after we purchase, that means we have 1 million shares circulated on the market, and investors are willing to buy or sell. That is 1 million shares. And after the company purchased 400,000 shares back, so they will keep those 400,000 shares inside of company, and those 400,000 shares will no longer be circulated on the market. So then how many shares left here after this repurchase transaction? How many shares left on the market to be circulated? 600,000 shares, right? So then after this treasury stock, after repurchasing this 400,000 shares, we have 600,000 shares outstanding. Okay, outstanding. All right. Oh, one more thing before this is that on the balance sheet. Okay, I'm gonna show you something. Okay, now keep. All right. One more thing I'm gonna show you is this. And you see here that under each section, under this common stock, okay, we have this par value, and we have this authorized and issued, right? So authorized 75 million shares for this company per se is saying that company have the rights to issue 75 million shares in total. Okay, so at most, it doesn't matter how much value this company is worth. It doesn't matter. Okay, the company can only company is authorized by SEC can only issue 75 million shares at most. At most. And here is issued. Also, you can say is outstanding, which means the number of shares that is circulated on the market, that is 50.6 million shares. Okay, so out of 75 million shares authorized, the company is be able to issue. They issued up to now 50.6 million shares to the market. So how many shares that left over authorized but not issued yet, which is 75 minus 50.6 million, right? And this 4 million shares, that is treasury stock, right? Remember, treasury stock is something that a company purchased back from the market and contained in the company. And this 4 million shares are no longer outstanding shares. That means this issued 50.6 million shares doesn't include this 4 million shares buyback by the company. Okay. All right, then Y company will buy those shares from buy back those shares. Okay, so first they send a signal that the company believe this the stock is worth acquiring. That means that company itself is willing to buy this his own stock. It means that they have a strong confidence that their company performance will be better or way better than what it is now. Okay, and then obtain shares to reissue to the purchase of other companies. If you are acquiring some other companies through that M&A process, and there's a negotiation, and part of the deal probably just you have to give me certain certain number of shares of your company stock, and then the company doesn't own that by the time they have to purchase from the market. Okay, so they cannot use those authorized shares because those are not issued. Okay, so they have to use that. And number 3 is obtain shares to reissue to employees as part of stock options. Okay, similar as the second reason. Okay, so they have to use some shares to motivate employees, but they don't have it now, so purchase back from the market. And then the last one is reduce the number of outstanding shares to increase per share measure of earnings. Okay, so if we are purchase those number of shares back on the market from the market, then the supply on the market is reduced, right? And then keep that demand constant, supply reduced, then your price of stock is just increased, right? So it's economy. All right. So this is the process of treasury stock that use. Okay, and treasury stock purchase, and once the company repurchased the stock, and the treasury stock does not have any voting rights or dividend rights. That means the company itself don't vote for things for itself. Okay, so they have to have some agents, right? So employees, owners, and company just simply they purchase those stock back doesn't mean the company itself owns some percentage of the ownership. Okay, it does not like that. Okay, and treasury stock, it is a contra equity stock account. That means if you're buying those back, you will decrease this treasury stock balance, will decrease the balance of stockholders' equities balance. Okay, that will decrease stockholders' equity balance. Okay, that is a contra equity account, which means all the balance will against stockholders' equity balance. All right. And when stock is reacquired, the corporation records the treasury stock at cost. What is cost? The market price. The market price. Okay. So now let's look at this example. Okay. Treasury stock repurchase of stock, and National Beverage acquired 50,000 shares of its common stock at $25 per share. So that means the market price for each share is $25 on the stock market. If the company wants to repurchase 50,000 shares, they have to pay $25 each on the market to buy it from the current owner on the market, right? So then $25 per share times 50,000 shares, whatever that total number is the cost for the company getting those 50,000 shares. Okay, so how do we record this? Usually, we're gonna use cash for those stock transactions, and also for company it's true as well. Okay, so if you want to buy those back, have to pay cash. Then our cash balance decreased. Okay, and we have a contra stock equity account, and then it will increase on the debit side, right? So debit treasury stock for $1,250,000. Okay, that is the total of $50,000 cost, and then cash balance decreased by that much. All right, so this is always how we record when we reacquired common stock back from the market. All right, and reissuance of treasury stock. Okay, remember we company buy those things back, and they are also can sell them to the market in the future date, right? So it's just the way it is that as the normal investors do on the market. Okay, so National Beverage reissued 5,000 shares of those treasury stock at $28 per share. So remember on the previous slide, the company repurchased 50,000 shares, right? And now out of this 50,000 shares, they sell 5,000 shares. Okay, they call it reissued. But it's just sell it back to the market. Okay, sell it back to the market. And at what price? 28. Then how do we record this transaction, right? So somebody are willing to buy these 5,000 shares at $28 per share on the market. Then we'll receive the cash for that amount, which is $140,000. And then again, because our treasury stock is recorded at its cost, so for each share of this $5,000 5 shares, we purchased at $25 each. Okay, so the cost of this $5,000 shares is $125,000. Okay, $125,000, and then our treasury stock balance decreased by $125,000. All right, because we sell out 5,000 shares out of that 50,000 shares, and then we sell it for 28, but our cost is 25, so we actually earned $3 for each one of those 5,000 shares, and those additional will be recorded in one one account. It's additional paid-in capital. Okay, additional paid-in capital. Okay, so that is 5,000 times the difference, which is $3 per share. Those $15,000 will be the additional paid-in capital by the investors. Okay, so then we'll finish this journal entry. All right. Now let's work on some problems. Okay, so far is for this video clip, and now we can work on some problems. Okay, first one. Okay, Face-to-Face Corporation report 100 outstanding shares, 500 authorized shares, and 50 shares of treasuries. And then how many shares are issued? Okay. All right. So 100 shares is outstanding, which means those are circulated on the financial market, and the company has the rights to issue 500 shares, and then they have 50 treasury stock, which they issued but buy back by the company. Okay. Oh, actually, treasury stock, it is part of issued. Okay, it is part of issued. Okay, so in total, number of shares issued is 150. Okay, so outstanding, the number of shares circulated on the market plus the treasury stock purchased back by the company from the market, these two together is number of shares issued. Okay. All right, 150 shares. Okay. So company authorized the 500 shares to issue, and then they only issued 150 shares. How many shares left not unissued? That is 500 minus 150. So we have 350 shares unissued. Okay. All right. Then next, okay, analyze recording the issuance of common stock. Okay, to expand operations, Oregon Consulting issued 1,000 shares of previously unissued common stock with a par value of $1. The price for the stock was $50 per share. Analyze the accounting equation effect and record journal entries. Okay, so if the par value is $1 and the stock market price for the stock is $50. Okay, for each share we sell on the market, we're gonna get additional $49, right? Now let's record this journal entry. Okay, and we have 1,000 shares, right? So we're gonna debit something is called a cash, because always gonna be a cash transaction. We issue the stock to the market, somebody buy it and pay us cash, right? And for this 1,000 shares, okay, and each share we sell it for $50, then we're gonna receive $50,000, okay, and then credit common stock, okay, credit common stock. And common stock only record the par value for this 1,000 shares. And each share, the par value is $1, and we issued 1,000 shares. So the par value in total is $1,000, right? So common stock par value is $1,000. And then we have a difference of $49,000, right? We have $49,000 difference, and this difference, to make this journal entry balance, we record as additional paid in capital. Okay, again, this is the capital we receive, but what it is additional paid in, $49,000. Okay, and now this is balanced. All right. Now it says if the par value is $2, what happens? How do we record this journal entry, right? So again, par value becomes $2. So the only thing that changed here is the par value. We're still gonna sell it $50 per share on the market. So we're gonna still receive $50,000 cash. So we're always gonna be debiting the cash for $50,000. And now the common stock balance will change because the par value increased by $1 and to $2 per share, right? So the par value for this 1,000 shares no longer is $1,000. Now it becomes $2,000. Okay, so now our common stock is worth $2,000. Okay, and now our additional paid-in capital will reduce to $48,000. Okay, that anything that beyond the par value is additional paid-in. Right? So, okay. So now that's if the par value change. This is how we record this. All right. So this is for this this video clip. Okay, and for those treasury stock transactions, journal entries is always going to be like those journal entries on the slides. Okay, so use those as your example. All right.